Welcome to the Opening Bell Report.
Usually when we open up a stock chart and see just a vertical line like a nearly 14% jump in a single day, the knee-jerk reaction is just, wow.
Right. It's pure spectacle.
It is. It's the kind of thing you text your friends about. But then if you actually stop and zoom out a little, you look at the broader context and you realize you aren't just looking at a stock chart. You're looking at a crime scene.
Or a battlefield.
A battlefield, exactly. And that is precisely where we find ourselves today with PDYN AI Corp, ticker symbol PDYN. Because this isn't just a story about a stock having a good Tuesday.
No, not at all.
We have this analysis report in front of us. It's titled PDYN Squeeze Alert. 22% short interest plus defense wins. And honestly, it paints a picture of a massive structural tug of war happening right now.
It really does. It's one of those classic market setups where you have this, irresistible force, in this case, a fundamental business pivot, slamming right into an immovable object.
And that immovable object is this massive entrenched wall of short sellers. And we're going to get into every inch of that battlefield. We need to talk about the robots, the Air Force, the cash burn, all of it. But let's start with that immovable object, the short interest. The headline number in this analysis is 22.69%. Now, for the uninitiated, that might just sound like a dry statistic.
But it's not. For anyone who follows market mechanics, that number is screaming crowded trade.
Incredibly crowded.
Oh, absolutely. To put that in perspective for everyone, usually if a stock has short interest over, say, 10%, people start paying attention. That's considered high.
Right.
When you get past 20%, you are in exceptionally dangerous territory. It means nearly a quarter of the entire the shares actually available for the public to trade is being bet against the company.
Which implies a massive consensus on the sell side. I mean, you have a huge chunk of the market convinced that PDYN is going to zero.
Or at least significantly lower. They are borrowing shares, selling them, and just waiting for the collapse so they can buy them back cheaper.
They are committed to the failure of the company.
Precisely. And that consensus creates, a structural fragility, because every single one of those short sellers has a future obligation to buy. They don't own the stock. They owe the stock.
They have to buy it back eventually.
They have to. And that's the bear trap mechanism the report talks about.
Right. When you have that much negativity priced in, any piece of good news, any spark can set off a chain reaction. The price ticks up, the shorts start losing money, they rush to cover, which drives the price up further.
And you get the feedback loop, the short squeeze. But here is the catch, and this is what we always have to remind people. You can't squeeze on thin air.
No.
A high short interest alone isn't enough. Companies get shorted for a reason. You need a catalyst. You need a reason for the bears to be wrong.
Right. If the company is actually going bankrupt, the shorts win, period. But that brings us to the core thesis of this deep dive. The bears are betting against the old PDYN. They are betting against what they think is a failing science project. But the report suggests that while the bears were looking at spreadsheets, the company fundamentally changed what it does.
That's the key disconnect. If you look at the bear case, historically, it was actually pretty rational. PDYN was viewed as a science project.
I love that term, by the way, science project.
Yeah.
Just conjures up images of really cool robots dancing in a lab, flashy demos, great YouTube videos.
But zero commercial viability.
Exactly. Cool tech, massive cash burn, no revenue.
It's the classic tech trap. And that is the graveyard of many, many tech companies. Short sellers feast on those companies because, statistically, most of them fail. They run out of money before they find a paying customer.
But this is where the plot twists. The report highlights a pivot that feels less like a tweak and more like a total reinvention. We aren't talking about abstract AI anymore. We are talking about the defense sector.
Specifically, the United States Air Force. This is a massive validation signal.
A huge one.
PDYN has secured contracts for inspection and maintenance robotics.
And we should clarify what that means, because AI is such a buzzword now. We aren't talking about an AI chatbot that writes emails for a general.
No. This is hardware. Robots that do the dirty, dull, and dangerous work. Think about stripping paint off a jet fuselage or inspecting composite materials for microscopic cracks.
Okay, so things that are incredibly tedious for humans, physically dangerous.
And require extreme precision. If a robot can do that, it's not a novelty, it's an operational necessity.
That is the distinction, isn't it, between theoretical tech and applied utility. One is a nice to have, the other gets written into the federal budget.
Absolutely.
But there's another layer to this pivot that I think is even more important than the contracts themselves. It's the acquisitions.
The guide tech or warn deals.
Right. I looked at this part of the report and initially thought, okay, they bought some small companies, so what? But then I realized what these companies actually do.
They aren't AI software companies.
No. They're manufacturing and precision engineering companies. And that is why this is such a brilliant strategic move and a dangerous one for the shorts. By acquiring them, Paladin is vertically integrating.
Yeah, let's break that down, because vertical integration is one of those MBA buzzwords that gets thrown around until it loses all meaning.
Sure.
Imagine you are an architect. You draw beautiful blueprints for a house. That was the old Paladin. They had the software, the mind of the robot. But to actually build the house, they had to hire contractors, deal with delays, pay markups.
Which is a nightmare when you're trying to sell to the military. The Pentagon doesn't want excuses about supply chain delays from some third-party vendor.
Exactly. They want the product on time. But now, by buying these manufacturing shops, the architect essentially bought the construction crew and the lumberyard. They own the means of production.
So they control their own destiny.
They control the quality, the timeline, and crucially, they capture the margin. Instead of paying a third party to build a robot arm, they build it in-house. That transforms them from a software company trying to do hardware into a full-stack defense contractor.
It feels like a maturity signal and says, we aren't just playing around with code anymore. We are building an industrial machine.
It does, and it's a signal the algorithm-based short sellers might be missing. The algorithms see cash burn and high valuation. They don't necessarily see strategic control of supply chain.
Speaking of valuation, let's pivot to the numbers. Because stories are great, but Wall Street runs on math. And the fuel for this potential squeeze, according to the report, isn't just the robots, it's the revenue guidance.
The jaws of life discrepancy, that's what they called it.
That visual stuck with me. You look at the chart, and the 2025 estimate is, well, it's fine. It's modest.
Yeah.
Around $5.5 million.
It's tiny. For a public company, that is practically a rounding error. If that was the steady state, the shorts would be right.
No question. The company wouldn't survive on $5.5 million. But then you look at 2026, management is guiding for $24 to $27 million.
This is an explosion.
It's a 336% to 440% increase year over year. That is hyper-growth territory.
And this creates a massive problem for the valuation argument that the bears are relying on.
How so?
Well, let's look at it through the eyes of a short seller for a second. Right now, PDYN is trading at something like 67 times its sales.
Which is an exorbitant premium.
It's insane. In a vacuum, paying $67 for every $1 of revenue is dot-com bubble stuff. So the argument is simple. This stock is expensive, it makes no money, so I will short it.
Makes sense on the surface.
But the market is forward-looking. If you believe the 2026 guidance, and that is the big if you believe they actually hit that $27 million number, that multiple just collapses.
Right.
Suddenly you aren't paying 67x. You might be paying 10x or 12x relative to that future growth. The stock goes from insanely expensive to reasonably priced growth stock practically overnight.
And that is the trap.
That's the trap. Short sellers target companies where revenue is shrinking. Paladin is telling the market, we are about to quadruple our revenue. If the company delivers, the overvalued thesis evaporates.
And those 22% of shorts are left holding the bag.
And we have to remember the size of the exit door here. Paladin is a small cap company. We're talking about a market cap around, $33 million? The liquidity isn't infinite.
It's a small room with a lot of people in it.
And if someone yells fire, or in this case, revenue beat, and 22% of the people try to run through a single door, that is how you get a vertical price move. It's just physics at that point.
Okay, so we have the fundamental setup, the defense pivot, we have the financial fuel, the revenue ramp. Now, I want to get granular on the battlefield itself, the technicals. The report lays out specific price levels that act almost like trench lines in a war.
They really do. In these squeeze scenarios, technical analysis becomes almost a self-fulfilling prophecy because everyone, bulls and bears, is staring at the exact same lines on the screen.
It becomes a psychological game.
Totally. So let's visualize this for the listener. Picture the stock chart. The report identifies a floor, a support level, at roughly $6 to $6.50.
Okay, $6.
That $6 level is critical. The stock has consolidated there. It's hung out in that range for a while. That tells us there is real demand. Every time the price dips to $6, buyers step in.
And if you were a short seller, that floor is frustrating, isn't it? You need the floor to break. You need it to go to 4, then 2.
You need it to collapse. You need panic. If the price just sits at $6 and refuses to go lower, your cost to carry, the interest you pay to borrow the shares, starts eating you alive.
It creates anxiety. It says the easy money is gone.
Exactly. So the floor is at 6. Now look up. The ceiling, or resistance, is listed at $9.50 to $9.60.
That's the line in the sand.
That's it. We saw the price try to punch through there recently and get rejected. That means there are sellers sitting at $9.60, likely people who bought earlier and are just happy to get their money back, or shorts reloading their positions.
But the report talks about a breakout scenario involving something called a gamma squeeze. We hear this term a lot now. Can we demystify that? What actually happens mechanically if the price breaks $9.60?
Sure. Without getting too bogged down in the options math, it involves the market makers, the banks that facilitate trading. When people get excited, they often buy call options betting the stock will go up. The market maker sells them that option.
But the market maker doesn't want to gamble. They just want the fee.
Right. They want to stay neutral. So to hedge their risk, as the stock price rises and gets closer to that strike price, say $10, the market maker has to buy the actual stock to cover the option they sold.
Oh, I see.
The higher it goes, the more they have to buy to stay hedged.
So if the price breaks $9.60.
It forces the market makers to buy. It forces the short sellers to start covering. And then the momentum traders see the breakout and they jump in. It's a triple whammy of buying pressure.
And the report points to an analyst consensus target of, what was it, $11.22?
Yeah.
So technically speaking, if we clear $9.60, there's a vacuum up to 11 or 12 bucks.
There's very little resistance in between. That's the blue sky scenario.
Okay, I can feel the hype building. And this is usually the part of the show where I have to be the buzzkill.
Please, be the buzzkill. It's necessary.
Because we cannot just present the bull case. We have to look at the risks section of this report seriously. Why are the shorts there in the first place? Are they just stupid?
No, they absolutely are not stupid. They are calculating. And the reality is, the science project reputation didn't come from nowhere. It came from the financials. PDYN is burning cash.
The stat in the report was stark. They are spending approximately $7 for every $1 they make right now.
7 to 1. That is a brutal ratio. In the startup world, you might call that aggressive investment. In the public markets, it's called cash burn, and it gives you a very short runway.
And that's what the shorts are banking on, right? The money runs out before the contracts kick in.
That's the bet. They are betting that PDYN will run out of cash and be forced to do a dilutive offering, selling more stock to raise money.
Which would crush the price.
Exactly. If they flood the market with new shares to pay the bills, the price drops and the shorts win. That is the ticking clock.
There is also execution risk. It's one thing to put a slide in a PowerPoint that says we will make $27 million in 2026. It's another thing to actually do it.
Manufacturing hardware is hard. As Elon Musk likes to say, prototypes are easy, production is hell. Supply chains break, parts don't fit. A 400% growth projection leaves zero margin for error.
If they stumble, the market will punish them.
Severely. So this isn't a buy it and forget it situation.
Absolutely not. This is a high beta, high volatility play. If they miss that earnings report in February, if they come out and say, actually, that guidance was a bit optimistic, the thesis breaks.
The squeeze fails, the stock likely retests the lows.
So the February earnings report is the prove it moment.
It's the Super Bowl for this stock. Everything hinges on whether management can look investors in the eye and reaffirm that massive growth guidance. If they do, the shorts are in trouble. If they don't, the bulls are.
It sounds like a gladiator match. You have the shorts on one side with their burn rate spreadsheets, and the bulls on the other with their defense contracts.
And the individual investor is standing in the middle trying not to get trampled.
So let's try to synthesize this for the listener. We've got a massive short interest, 22%, colliding with a company that is potentially transforming from a cash-burning lab into a vertically integrated defense contractor.
That's the formula, the irresistible force meeting the immovable object.
And if we want to boil this down to a single actionable signal, what is the number you'd write on a sticky note?
The report emphasizes $7.50.
Why $7.50 specifically? It's right in the middle of that channel.
Because it represents momentum. If the stock can close above $7.50, it signifies that it has successfully bounced off that $6 floor and is now magnetically drawn toward that $9.60 ceiling.
It's the midfield line. Once you cross it, you are on the offensive.
That's a good way to put it. $7.50 is the signal that the squeeze might be starting.
Got it. But you know, as we wrap this up, there is one final thought that keeps nagging at me. It's about the nature of the opponents in this trade.
What do you mean?
Well, think about who's on the short side. It's largely algorithms, quantitative hedge funds. They run models that screen for high valuation plus high cash burn, and they automatically short.
It's cold, calculated logic, a spreadsheet decision.
The machine. But look at the long side. Who is the partner? The U.S. Department of Defense, the Air Force. That is an institution with a capital I.
That is a fascinating dichotomy.
It really is. The algorithm doesn't know about geopolitics. It doesn't know about the strategic necessity of keeping aircraft maintenance efficient in a time of global tension. It just sees a bad P&L statement.
So the market might be mispricing the reality of the government's need because the financials look ugly.
Exactly. And in a battle between a mathematical short model and the military-industrial complex.
History usually suggests you don't bet against the procurement budget of the United States.
The computer code versus the institution. That is a heavy thought to leave us with. It's not just about the stock price. It's about what the market sees versus what the real world needs.
And that gap, that misunderstanding, is exactly where the opportunity lives. And the risk.
Well, there you have it. The PDYN AI Deep Dive. a potential squeeze, a defense pivot, and a whole lot of volatility on the horizon. We'll be watching that $7.50 level closely.
Definitely one for the watch list.
Thanks for listening.
Don't forget to like, share, and subscribe for more.